Namaskaram, ladies and gentlemen. This is C.S. Sudarshan. I hope you are killing it in your studies. And now we are going to start with the revision of chapter number 1, nature, scope, and objectives of audit. So, a part of the chapter will be revised from the book, from the revised audit, the book, and some important areas where you need conceptual clarity. I will take it through normal charts and graphs and like navigate it through that. So this is a chapter. So before we head into the chapter, let's look at the structure of the chapter. So this is the way I teach auditing. Before we start a chapter, the structure of the chapter should be in your head. So first, let's look this chapter. First, we'll be learning about the meaning of auditing. I've divided the chapter into 4 chunks. So that is how we teach, right? So first is the meaning of auditing. First is the meaning of auditing, then who are the users of financial statements, everything. Independence, how auditor ensures financial statement does not mislead anybody. Relationship of auditing with different subjects. Objective, scope, limitation, benefits. Engagement, qualities of auditor, standards. So this is the structure of the chapter. I don't want to waste your time. Let's do the revision. So first, I'll talk about origin of the word, everything, basics. Whatever textbook concept note you are using, you can use that. I'd be happy if you are using revise audit like this one. I just showed it to you, that's it. So in any textbook, most of the books, this will be the same format in which your book will be, right? So you can easily watch it. So first is, what is the meaning of auditing? Auditing means it's an independent examination. What is independent examination? Independent means auditor should not be related. What is independence? Auditor in no way should be related to the company. He should be independent. That is, imagine you are the auditor. Imagine Aman Gupta bought the company, right? And I and Aman Gupta are brothers. And he hired me to do the auditing. I just go there. I identified a fraud. Will I report it to the government? No, right? Because it is my brother's company. That is first case. Second case, imagine we are not related. I am going to audit board. We are not brothers and nothing. But I hold 10 lakh shares in board. And I identified a 10 lakh fraud, 10 crore fraud. Will I report? No, right? Because if I report, the value of the stock will reduce in the market and my money will also go. If it comes out that there is a fraud in the company, right? So that is why ICA has mandated that the auditor, I see it everywhere around the world, auditor should not be in a position to get influenced by the client. Client should not be able to influence auditor. That is what we call independence. So you should not be related in any other way. You should not be holding any interest, anything, any shares, nothing. You should be completely separate entity. You should be independent. If you do the audit, you identified there is a fraud, you should be able to say to the government, say to report that there is a fraud. That is what we call independence. Your judgment should not be below, should not be subordinate to the wishes. Your judgment as an auditor should not be subordinate to the wishes of the person who hired you. You should be strong enough to say to that, yeah, you have done the fraud, I'm going to report. I'll report to the shareholders, I'll report to the government, whatever, depending upon the amount of fraud. So, audit is an independent examination. That is, auditor is an independent person coming from outside, not related. Independent examination of financial information. What is financial information? Sales, purchase, everything in the financial statement, amount. Financial information of an entity, and this is part number 1. Audit is independent examination of financial information of entity. 1. Whether that entity can be profit-oriented entity or non-profit-oriented entity, irrespective of entity size or legal form. Entity can be either profit-based, working for profit, or non-profit organizations, or entity can, that is, irrespective of entity's size. It can be a big company, it can be a small company. Irrespective of its legal form, it can be company, partnership, proprietorship, whatever it is, that is legal form. So first part, till here, we'll break down the definition into 3 parts. So it will be easy for you to learn. So audit is an independent till here. Then next is about the entity, whether profit oriented or not, irrespective of its size or legal form. This is about the entity. And why are you doing the examination? To express an opinion. You are being hired by the owners of the company to do the audit. And what is your duty? You have to do the checking and report to the people who hired you, right? That reporting is what we call expressing your opinion. You check the audit, and whether it is correct, you will express that opinion. Whether if it is wrong, you express that opinion. Simple. So it is an independent examination of the financial information of the entity. Done. And now it is about the entity, whether that entity can be profit oriented or not, irrespective of its size or legal form. Okay, done. Second part done. And why are you doing the examination? To express an opinion thereon. Simple as that. Done. Khatam. Then this is independence. I told you, judgment, you should be independent. You cannot audit the accounts of a company in which company of your brother. That is what is written here. And if you are holding shares of any company, you cannot audit that company because you are not independent. If you identified any fraud, will you report? No, right? Simple. Now this question, preparation and presentation of financial statement is a responsibility of management. I've told you, like if this is the company, shareholders are there, then management is here, then employees are here. So financial statements are prepared by the management, and to check these financial statements, shareholders will hire the auditor. Simple as that. Got it? So I told you it is the auditor's duty to check the financial statement. So now my next question is, how will auditor ensure that the financial statement does not mislead anyone? Before that, understand this one thing. Who are the users of financial statements? Who use the financial statement? When a financial statement is made, if a company want to take loan, when they go to a bank, bank will immediately ask, give me your financial statement first. So bank is a user of financial statement, right? Audited. Bank will, okay, look, okay, everything profit is correct, okay, we'll give loan, depending upon that. Creditors, government, because we pay tax based on the audited financial statements profit figure. That profit into 30%, right? So government is also a user. Investors, everyone is a user. So, and they are believing in the auditor. Company prepare a financial statement, and these users are actually believing in that financial statement only because an auditor has checked it and signed it. So it is auditor's duty to ensure that he is not misleading anyone. That is, he is doing his duty perfectly. How will auditor ensure that? That is the question. How will auditor ensure financial statement does not mislead anybody? Question number 10. If you look at my question bank, you can see question number 10. This is the question bank, and this is one quality of this book. Cross-referencing is there. This is the question number 10. How we would ensure financial statement does not mislead anybody. Since it was an easy question, I asked my students to cut it off in the lecture. That is different. Okay. How he will ensure? First is account finds. That is the mnemonic. Account finds. Account. Accounts have been drawn up with reference to entries in the books of accounts. First, he will make sure that all the figures in the financial statements are coming from the books of accounts itself. He will cross-check that all the accounts are made up from the books of accounts itself. Figures are the same. He will tally that. That is first account. Then F, financial statement amounts. Financial statement amounts are properly CDD, classified, described and disclosed as per accounting standards. That is, he will see. He will make sure all the amount in the financial statements are as per accounting standards. Same. All the standards, everything are followed properly. Simple. Account finds. Account finds. FI. Information conveyed in the statements are clear and unambiguous. Information I. Information conveyed in the statements are clear. That is, there is nothing wrong, nothing is there. And unambiguous. Unambiguous means, ambiguous means some doubt is there. Whether it is correct or not, or some doubt is there. But unambiguous means no doubt. Perfect. That's it. Then unambiguous. Then unambiguous. Then FIN. None of the entries in the books of accounts has been omitted for compilation. That is, company may have 10,000 sale bill. So the total of that bill should come as sales figure in the P&L, right? So auditor need to make sure all these 10,000 bills has been entered. None of these entries, books of accounts entries, has been missed in the process of compilation. FINE. Entries in the books of accounts have sufficient and appropriate audit evidence. If there is a sales figure of 10 lakh, make sure the bill of 10 lakh is also there. Audit evidence is also there. FINES. Statement of accounts. Statement of account means financial statements presents a true and fair picture of operational results and assets and liability. Make sure that also. So simple. Account finds. Account FINES. Got it, right? Then next is interdisciplinary need. And if you find it fast, just pause it, register this thing in your head, and then move to the next page. Next topic, because it's a revision lecture. We have to make it below like 30-40 minutes. So interdisciplinary nature of auditing, that is, let me ask you one thing. You are studying CA to become an auditor, right? Chartered account auditor, most of you. So why do you want to learn other subjects? If you want to become an auditor, just auditing is enough, right? Why are you learning tax, accounts, law, all these subjects? Because as an auditor, you need an expertise in these subjects too. So auditing always has a relationship with other subjects. So what are those subjects in which auditing has a relationship with? Simply look at your syllabus, inter-syllabus, accounts, law is there. Now look at here, accounting is there, law is there, economics was there earlier, economics. Then we have statistics and maths in foundation. Then financial management, now you have production, that is costing. Everything is there. Then the extra thing is behavioral science. Behavioral science means when you are doing your articleship, you will learn about people. Like you will, when you go for out audits, there will be so much people coming to become your friends, accountants, everyone, because they may have done some fraud. So just if they are showing some over friendship, beware, they have done some fraud. So that is behavioral science, judging someone and doing all these things. Knowledge of human behavior is essential. You learn all these things. So these are the subjects. Simple, we are CA inter subjects and foundation subjects. Keep in mind and write the heading. That's it. Then next is behavioral science and EDP. Then what are the objectives of audit? Objectives of audit. Why are you doing the audit? That is my simple question. Why are you doing the audit? That is what we call objectives of audit. We are doing the audit, we are checking it, right? So we are doing the audit as per SA 200, overall objectives of independent auditor and conduct of audit in accordance with standards on auditing. SA 200. Our objective is to obtain a reasonable assurance about whether the financial statements as a whole are free from material misstatement, whether due to fraud or error. That is, first we have to get a reasonable assurance. That is some sort of an assurance, some guarantee to ourselves that we have checked the financial statements and there are no material misstatements. What is material misstatement? What is material misstatement? I'll just show it to you one second. Just look at here. This is financial statements. Imagine this is applicable financial reporting framework. So what is your duty? Your duty is to check that whether financial statements is as per applicable financial reporting framework. This means this applicable financial reporting framework means the Schedule 3 format, the Ind AS accounting standards, all the rules and regulations you need to follow to prepare a financial statement. Your duty is to check whether it is as per AFRF and whether there are any errors or fraud or misstatements, anything. So you are coming to check whether everything as per AFRF is followed in the financial statement. If everything is paka, okay, done, superb. But if everything is, something is wrong, something is error is happening, some error, fraud, something is there, that is what we call a misstatement. That mistake is what we call a misstatement. And misstatement are also of two types. Misstatement of big impact, misstatement having big impact, and misstatement having small impact. Misstatement having big impact is what we call material misstatement. Small impact misstatement we will just ignore. I'll give an example. A company with a turnover of 10 crore and there is a misstatement, a mistake in the expense of say for example 10,000 rupees. Company is having a turnover of 10 crore and here a misstatement is of like 1,000 rupees. Is it something like, leave it, right? It's a small misstatement, we'll ignore. But company is having a 10 crore and there is a mistake in the expense of say 1 lakh. That is a very important mistake, right? So that is a material misstatement. We'll consider that as a material, significant misstatement. If that misstatement affects the user's decision, users I told you who are. If this mistake affects the user's decision, then it is called a material misstatement. Simple example, one more example if you want, I can say. That is, the actual profit of the company, imagine, is 10 lakhs. This is now the profit in the P&L. But there is a mistake in expense. One expense has not been properly recorded, or one sale, not expense. You think one sale of 5 lakh has not been recorded. 5 lakh sale has not been recorded. If this 5 lakh sale was actually recorded, the profit will be 15 lakhs, right? Because sale increase, profit increase. So it is not recorded. So it is a material misstatement because it affects the users. If this was recorded, tax will increase by like 5 lakh into 30%, tax will increase. Tax should have been increased. The company's valuation will increase. So it is important for users because 5 lakh sales profit increase, the company's valuation, everything will increase. Tax will increase. So it affects the users, their decision regarding the financial statement. An investor, seeing only 10 lakh profit, they may have not invested. But if 15 lakh profit was there, they would have invested. So the decision was affected. So that is a material misstatement. Same here, if the sale figure in this case itself, imagine the sale figure was a sales of 10,000 was not entered, or not even, we'll say even smaller amount. We'll take it like a 5,000 was not entered. 10 lakh profit or 10 lakh 5,000, what is the difference? No difference is there, right? Small. So we'll ignore that misstatement. That is immaterial. Got it, right? Hope you got it. Okay. Okay. So what are the objectives of auditing? First, to obtain a reasonable assurance that the financial state, we cannot obtain absolute assurance. Reasonable assurance that financial statements are free from these material, important misstatements due to fraud or error. And when you obtain yourself a reasonable assurance, then you can enable the audit, because it enables the auditor to express an opinion that financial statements are as per applicable financial reporting framework. I told you here, financial statement, financial reporting framework, your duty is to check whether both are same. So first you will obtain a reasonable assurance, about whether financial statements are free from material misstatement. So now you have the reasonable assurance. So now you can express an opinion. Now you can say whether it is correct, whether it is wrong, whatever it is, all those things. And next your duty is say it. That is to report on financial statement as per standards on auditing. You can report that. Simple as that. Nothing to overcome. Then what is reasonable assurance? What is absolute assurance? Absolute assurance means 100% assurance. Can you guarantee something? No, right? For example, as an auditor, you can never guarantee something because there are a lot of limitations which we'll learn. Inherent limitations of audit, we'll learn that. So reasonable assurance means you checked everything. As of now, what I've checked, everything is okay. That is what you can only say in auditing. Absolute means 100% assurance. You can never give it in auditing. I'll give one example because 10,000 bills are there. And can you check the 10,000 bills? No, right? You can only check max to max 100 bills a day. 100 bills or 50 bills. Because 10,000 bills, if you need to check, it will take you 5 months for auditing. Auditing, you will only get 1 or 2 months. So you'll only check some 50 bills. You are checking it within a sampling basis. This 50 may be good bills, but some other bills may be there which is fake. You may not know that. So how can you give the guarantee that it is 100% correct? That is why I say you cannot give absolute assurance. You can only give reasonable assurance. Got it? Then, what is the scope of audit? Scope of audit, I'll give you a simple example, a simple, easy way I can explain it to you. Yeah, look at here, scope of audit. Scope of audit means it is actually a boundary. Scope means a boundary. Look at me, not here. Scope means a boundary. What are the things that is actually coming inside the audit? That is what we call scope of audit. If something is, what all are the things that you as an auditor need to do in auditing? There are many things you need to do, and there are many things you don't want to do. So what are the thing coming inside, thing coming outside? Just remember this one pictographic way, we'll remember this. Okay. First is cover all the aspects of the entity relevant to the financial statements. All the aspects of the entity means this sales, purchase, expenses, closing stock, all these things, assets, liability. Only cover all the aspects that is relevant to financial statements. Only financial statements. Imagine you go to auditing and there a relationship is happening, like a love affair is happening between one employee and another employee. Is it your business to look at that? No, right? You only have to cover all those aspects that is relevant to financial statement only. You have to check the sales figures, all these things, all the amounts in financial statement. First thing. Next, Reliability and sufficiency of financial information. When you are checking sales expense, you will cross check it with bills, vouchers, etc. Right? Sales 10,000, you'll ask, give me the voucher, give me the bill. You'll cross check both. So you have to make sure that this evidence, everything is reliable and sufficient. Make sure you can rely on this bill. Make sure it is not fake. You cannot make sure, but just see whether can you rely on that. And sufficient means imagine there is a purchase of 10 lakh. You asked for the bill, they gave you the bill, but it seems like the bill is not okay. So you will think, that evidence is not sufficient. Give me your bank account, let me check whether money has gone to the creditor. So you ask for another evidence. So that is what we call sufficiency. So till you get satisfied that 10 lakh is correct, you can ask for more evidences. That is what we call sufficiency. Quantity of evidence. Reliability, obviously like quality of evidence. Can we rely on that? So make sure reliability and sufficiency of financial information. Everything. Okay. Then next, proper disclosure of financial information. All the items that require disclosure, all the items that are properly as per the Schedule 3 format, everything is done and dusted. Make sure that. So these are the only areas you as an auditor need to check. You don't have to worry about anything else. And these are the areas where auditor don't need to check. First is, he is not expected to perform any duty that is outside of his domain. His means auditor's domain. You went to check audit the assets. You went to physically verify the asset. Like 3, 4, 5 plant and machinery is there. You went to audit the plant and machinery. So what will happen? When you are verifying the plant and machinery, are you an expert in doing that? No, right? You are not an expert in verifying plant and machinery. So you cannot verify. You can just normally verify the plant, okay, the condition is good, okay. But you cannot deeply, you are not an engineer, you cannot deeply go and verify everything, no, right? So the basic things you can do, other than that, it's outside your domain, you are not expected to do that. Then auditor is not an expert in authentication of documents. Imagine they produced a fake bill and you are unable to find that, but that's not a problem because you are not an expert in that. Nobody is expecting from you. Just your plain sight, in your plain sight, if you could identify that, it's okay. Then audit is not an investigation. You don't have the power to kick the door open, search everything. No. You can only have the power of normal checking. So these are the 3 things that are outside the auditor's domain, and these are 3 things that are inside the auditor's scope. Now you understood scope. Pictographic. Scope means boundary. What are the things auditor need to do? It's inside. Things auditor should not do outside. Keep in your brain. Keep it in your brain. Nothing like. Then limitations of auditing. I told you auditor can only give a reasonable assurance. Why? Why can't he give an absolute assurance? There is a reason for that. First, because of the nature of financial reporting. Because auditor cannot give an absolute assurance. Everything is perfect. He cannot say that because of these limitations. First is nature of financial reporting. That means in financial reporting, even if I am going slow, you pause and get everything and go slow because it's a revision class. I need the speed. So nature of financial reporting. That means what is financial reporting? The process of making financial statements is what we call financial reporting. Financial statements, all the reports, everything. So like from a journal entry to ledger, this entire process. So the nature of financial reporting, management make a lot of judgments in that. For example, selecting the accounting policies, depreciation. They can use the straight line method, WDV method, and they used WDV. That is management's judgment. They could have used straight line method also. So similarly, many judgments are there in the financial statement. Auditor cannot sit and verify everything whether it is correct or not. So because that is a limitation, and because of that reason, auditor cannot guarantee that financial statements are perfect. Sometimes that limitation may be correct, not judgment may be correct, sometimes it may be wrong. We cannot look at everything because we have limitations. That is one. Next, nature of audit procedure. Audit procedure means I told sampling, 10,000 bills are there. How can you check the entire 10,000 bills? No, right? You can only check 50 or 100 among them. So that 50, 100 may be correct, but the other may be wrong. But you saw that 50, 100 as correct sampling. Okay, you gave good, everything is good. But the other 10 or something may be wrong in that, right? So that is a limitation. You may not know. Some bills, fake bills, something will be inside. You may not know that. So that is also a limitation. Sampling. And sampling is a practical limitation because we cannot look and search the 10,000 bill. It's not possible. Then management may not provide a complete information. That is another limitation. You asked management to give all the purchase bills. Sometimes they'll only give 10 bills, and you have to, then you don't have an option to force them to give. You can only report. That is our limitation. Then management itself may do the fraud. Management itself may do the fraud. So, and they are so good at concealing it, you may not be able to identify it. That is also a limitation. And they'll enter into related party transactions. You may not even identify that, because imagine management, like 3 people in management are a fraud, and they have their brothers or something are related parties, and they are in the creditor segment, creditors, purchase, something is there. How will you identify these creditors are manager's brother? Is there any way to identify that? No, right? So we may not be able to identify related parties. We can only ask them. They may say, they may not say. We don't know. So that is also another limitation. Auditor cannot identify the related parties. So because of the nature of financial reporting, nature of audit procedure is a limitation. Then not in the nature of investigation. I told you, we don't have the power of investigation. So you go to auditing and there one room is locked. You can't ask, open that room, let me see what is inside. You can't ask that. Even if you ask, they will not open. You don't have the power to forcefully open. That is a limitation. Then timeliness of financial reporting. Let me ask you, if I am the auditor for a company for 3 years, same, last 2 years before I prepared, like last year I prepared a report on their internal control adequacy. So this year when I am going, sometimes I may think, oh, last year I prepared same internal controls, everything is same. Why should I prepare something extra? Let me rely on that. Most of the auditors will do this. So last year we prepared that, so this year why should we do that again? Let's rely on that. But sometimes some information has changed in this year. Imagine, take a company, Boat, earphone company. Last year I prepared a competitors analysis. Last year the competitor was JBL. So I thought, okay, everything is okay. So this year also I believe, yeah, everything is perfect. Last year I did the detailed analysis, right? But this year the competitor is Noise. Companies are different. So the relevance of information of last year and this year decreases. Last year's information is last year's information. The relevance of that in this year may decrease. You may not know. So auditors will definitely rely on these kinds of informations. That is a limitation. Understand? Okay. Then future events. Future events means this year a case is happening against company. Imagine. So when you are doing the auditing, everything is perfect. So you give, imagine, absolute assurance you give. Normally you cannot do that, but you gave absolute assurance. What will happen? Like 3 months after, sometimes the company will lose the case and entire company going concern itself is gone. Company is gone. So what about absolute assurance? You gave absolute assurance that the company is having going concern, everything perfect. Company will win the case. It will never happen. And so because of the future event, you cannot predict the future. So don't give a 100% guarantee that everything in the financial statement is correct. That is why auditors only give reasonable assurance. So in future, if something happens, we can wash our hands and leave. Right? That is why we give only reasonable assurance. So these are the limitations. Nature of financial reporting, nature of audit procedure, nature of not in the nature of investigation, timeliness of information decrease over time, future events. 5 limitations because of which we cannot give absolute assurance. These are the limitations. Then what are the benefits of auditing? What are the benefits we get from auditing? Just take a pause and listen. What are the benefits? First is Himo here, Deva share. Simple. Keep in mind. Just by doing the auditing, what are the benefits company is getting? What are the benefits? Company, everyone is getting by doing the auditing. First is Himo, Achai, high quality information. When a financial statement is audited by the auditor, everyone can believe in that because auditor has signed. It is perfect, right? So it is a high quality information. High quality information, it gives confidence to users. High, HI, Himo here, HI. Then MO, it acts as a moral check on employees. Means employees will not do any fraud, because they know at the end of the year auditing will come and they will get caught. So it is a moral check on employees. Himo, high quality information. MO, moral check on employees. Himo here, HE, it is helpful to the government authorities because financial statement is audited by auditor. So the tax paid will be correct. Government can trust on that. So helpful to the government. Himo here, HI, high quality information. MO, Moral check on employees, here HE, helpful to the government, RE, relied upon by lenders and bankers. Because bank can also trust. It is audited by an auditor. So it can be relied upon by bankers and lenders. HIMO here, high quality information, MO, moral check, HE, helpful to the government, RE, relied upon by the bankers. HIMO here, Deva share, DE. DE means detect fraud and error. When you are auditing, you can detect fraud and error, DE. VA, you can, when you are doing the auditing, you can check the operating effect, you can check the operations and effectiveness of various controls. Various controls, DEVA, DE, detect fraud and error, VA, various controls, check the operating effectiveness of, review the existence and operations of various controls. DEVA share, shareholders. Shareholders will only put the money and they may not be associated with business daily. They may not be coming to the office daily. So they will hire an auditor to check whether everything is correct or not. So it is a confidence to their shareholder also. Their interest is safeguarded. HIMO here, Deva share. HI, high quality information. MO, moral check on employees. HE, helpful to the government. RE, relied upon by bankers and lenders. DE, detect fraud and error. VA, operations of various controls. Shareholders, done. And who appoint auditor, all these things are very easy. Then assurance engagement. Assurance engagement means an engagement in which auditor may enter into two, and not auditors. There are two types of engagements, two types. One is assurance engagement and next is non-assurance engagement. In assurance engagement, we will give a guarantee that not 100%, not absolute assurance, we will give like a guarantee that financial, whatever we checked is somewhat correct or not. In non-assurance engagement, we don't give any guarantee. Simple. So assurance engagement, auditor will give a report and will say, we'll either give a reasonable assurance or a limited assurance or some moderate assurance, something we'll give. So assurance means assurance means I checked this thing, it is okay, it is correct, I can give it, so that others can trust. A practitioner expresses a conclusion designed to enhance degree of confidence of intended users. When I give an assurance, they can trust me, right? They can trust it. So what are the elements of assurance engagement? What are the things coming inside assurance engagement? First is practitioner. What is the difference between a practitioner and an auditor? There may be students who don't know this. Keep it in your mind, a practitioner means a CA in practice, just like that. A chartered accountant who is in practice, he do the auditing. At that case, he is the auditor. And he also do some other services also. Some consulting, some advice, sometimes branding, marketing, tax, stock market help. They may do a lot of these things. So all these things together is called a practitioner. An audit CA will do the audit plus the other services also. Then he is a practitioner. That is normally practitioner. Okay. CA in practice, it's a person who provides the assurance. Then responsible party, the client, who is our client, whose financial statements we are checking, whose reports we are checking. That's it. Then intended users, who are the users of those. For example, in case of audit, who are the users? Like bank, sometimes some internal control assurance report, something they'll need. So in that case, who is the intended users will change. You don't have to think about that, just understand this. Then subject matter, what is the matter being checked? In case of auditing, financial statements, information examined by the practitioner. In case of audit, it is financial statements. What is suitable criteria? That is, what are the rules and regulations based on which we are checking? Here we have a financial statement. How will we make sure this is correct? When we'll cross check it with the standards on auditing, not standards, like accounting standards, all the rules, everything we'll check, right? So that rules is what we call suitable criteria. These are benchmarks, standards which we kept to cross check whether this is correct. Then sufficient appropriate evidence. Sufficiency refers to quantity. I told in that case to check one purchase bill, you asked for purchase, you asked for purchase bill and he gave you one bill and that bill was, you were not ready. So you asked for another bank statement. So that is sufficiency, quantity of evidence, quantity of how many things you need, purchase bill, bank statement, how many evidence you need. That is sufficiency to get satisfied. Appropriateness refers to quality. What is the quality of evidence? Sometimes if that purchase bill was good, just that one evidence itself is needed. Why do you need the other evidences, right? That is a quality of evidence. Then that's it. Then audit versus review. What is review? Audit, I told you, it happens only once in a year. We do the entire year's checking. Review means Reviews like, for example, these listed companies listed in the stock market, they have to do a review every 3 months. Quarterly, they have to submit a small financial statement of the 3 months to SEBI. 3 month financial statements. That is what quarterly report will say. So, in auditing, we are checking everything. But in review is a smaller version of auditing, where we'll just suddenly we'll check everything and give. Auditing, we have time, 1 or 2 months we'll take for auditing a company, but review we'll do it in 10-15 days. Details, not detail, like 3 months checking, tuck, everything is okay, done. Okay, that is review. Audit, we will give reasonable assurance because we checked everything perfectly. But review, we are not perfectly, like whatever is possible for us. And review, it is below that. We could not check everything perfectly. So there we will only give a like a limited assurance. Understand this? Okay. And difference between reasonable and limited. Reasonable is a high level of assurance. It is a lower level of assurance. Then here detailed checking, everything is there. Here no detailed checking. Then review, engagement, auditing, very different. Read it, you will get it. Nothing important. Then what is prospective financial information? Just look at this. This is today. In auditing, you will be auditing the data of the past. For example, 23-24 financial year. You will be auditing that after March 31st, 2024, right? You will be auditing it in June, July, August, something. So you are auditing the data which has happened in the past. Audit. Review is also like that, like 3 months. Only after 3 months you are doing the review of the past 3 months. So in both those cases, it is of historical financial, because the data is past, old data. So you are checking, it is a historical financial behind. And the opposite is called a prospective financial. Prospective financial information is today you are setting. So what will be the profit, sales, expense, etc. of the company for the next 5 years? You will do like a projection in Excel, current year sales, etc. So 10% increase, 10% increase, you will do like this. Expense also 10%, 10%, 10% increase. You will make next 5 years financial, projected financial information, financial statements like that. That is what we call projection. So that is what we call prospective financial information. In the prospective financial information, can we give a reasonable assurance or like an absolute assurance? No, right? Because in normal audit itself, we cannot do that. And in projection, the event has, it is a future. We are just predicting this will be the sales. We are just focusing on the assumptions, right? Assumptions we are giving. Management will make the prospective financial statement. They will give assumptions like, okay, next year our sales will, next year rain will happen, so our sales will increase by 2 times. Imagine it is an umbrella company. So next year rain will be more, so our sales will increase by 2 times. So they'll, this year if sale is 10 lakh, then next year they'll put it as 30 lakhs. So similarly, projection based on assumptions, they'll make this financial statement information of next year. So auditor will just go through this, and auditor cannot give a reasonable assurance or anything. So he'll just, because it's future, we don't know. So he'll give a moderate level of assurance. He'll say, based on the assumptions that I checked, like he's here. Auditor checks everything. Based on the assumptions, I believe like nothing has come to my mind to say that these assumptions are unreasonable. That is, auditor may say, I checked everything. Yeah, as of now, I believe the assumptions are reasonable. He cannot say everything is perfect. He'll say, assumptions I checked, it is okay, done. Okay, he'll give a moderate level of assurance, nothing above that. So in auditing, it is reasonable assurance. In review, it is limited assurance. In prospective financial information's case, he will provide assurance regarding the reasonability of the assumptions forming basis of projection. Then report on controls, internal the checking, some other that I'll explain, don't worry. He'll provide assurance regarding design and implementation of controls. That means they came to ask you to check, ask the auditor to give a report on internal controls. It is also there, so he'll give an assurance on that. Don't worry about that. I'll explain that. Wait, here we'll explain that. Then qualities of auditor, he just read it. It is very easy. Like he should be tactical, he should be caution firm, good temper, integrity. He should have a quality of a good businessman. Critically review the financial statement. Exhaustive knowledge he should have. Basic human quality, trust. Simple. Then comes the engagement and quality control standards. It is very important. That is, I'll explain it with yeah. What do you mean by engagement? Engagement just means work. work. When I, a chartered accountant, accepts to take the audit of a company, me and that company will enter into an agreement. That is what we call engagement. Okay, just understand this. Engagement letter. So just leave that. That is not needed now. Engagement standards means there are two types of work, two types of engagement. First is assurance engagement, where we will give some sort of a assurance that it is correct or not. I mean, we'll check everything and we'll give a, okay, we guarantee that, like a small level guarantee, next level. So assurance engagement. Non-assurance engagement is also there, where we don't give any guarantee. So in assurance engagement, there is auditing. First is audit. For audit, we have to follow SA, standards on auditing. When you are doing audit, just to follow SA, standard on auditing. No, nothing other than that. And in audit, we give a reasonable assurance. Okay. And for review, I told you, we need to follow not SA, we need to follow SRE, standards on review engagement. Don't need to worry about this. You will study these three only in final. You only need SA here in inter. So don't overthink. Just understand this much. For review, you will use SRE, standards on review engagement. In review, you cannot guarantee everything like audit. Here you will give only limited assurance. Okay. Review of interim financial statement of both. Then there is other assurance. Assurance means engagement in which you give some sort of a, you check everything and you give a guarantee. So in audit, you check everything, you give a guarantee. Review also, you check everything, but moderate guarantee you give. But there are some other cases also, other assurance engagements where you give a small guarantee. That there you have to follow SAE. Other than audit, there you have to follow SAE, standards on assurance engagement. For example, like this, places where the audit signs and gives something. He checks the client came and asked the auditor, please give a checking on our internal controls and give an internal control report. So they will enter into an assurance engagement. Auditor will go check the internal controls, everything. Then he checked everything detailed, right? Then he will give sometimes a reasonable assurance or a limited assurance, whatever he wants. He give an assurance. I checked the internal control, everything is perfect, so I am giving a reasonable assurance. He can give that. For example, internal control assurance, compliance assurance, everything. And prospective financial information, I told you, right? There, reasonable assurance you cannot give. There, because I told you, it's like a moderate assurance only you can give. It should not be written here. Yeah. In case of prospective financial information, I told you, only moderate level of assurance you can give, because it is like, see. Yeah, only moderate level of assurance you can give. You cannot give reasonable assurance. Okay. This and this three, you don't have to worry, only focus on this. Then next something is called SRS, standards on related services. This is applicable if you are doing a non-assurance engagement, where I am not giving any guarantee. For example, board came and asked you, can you help me prepare my financial statements? My management team don't know. So auditor will go and help. There, no report, like no formal report, no signing, nothing is there, no guarantee. It is called SRS. So there we need to follow standards on related services. Got it? Then chapter is done. Then one more thing at the end, then standards on quality control, SQC. This is set up to make sure that the quality of work is there in the audit firms, the CA firms, to make sure that the work they give out to the client is of good quality. For that, SQCs are there. SQC1 is an example. Then why are standards needed? Standards to carry out the auditing procedure and establish the benchmark, improve the quality of financial reporting, promote uniformity. Simple things are there. There is no need to worry on that. So that's it. So that's it, guys. This chapter is done. So tomorrow we'll meet with chapter number 2. And that's it. You listen to it once more if anything is complicated. Okay, bye. And if you're new to this channel, kindly, if you like the video, just give it a thumbs up and just write it in the comment box. Something, so I'll feel happy, and subscribe to the channel, because we are sitting and providing value, right? So that's it. Bye.